Okay, welcome grade 11s. I'm sure everyone's feeling a little bit stressed, but there are no worries at all. I will try keep you as up to date as possible, but hopefully this will be over before we know it. And yeah, I'm just going to try keep this YouTube channel as up to date as possible, even when we're not in the lockdown, just so that everyone is on the same page. So we have already introduced the partnerships general ledger accounts, but I'm going to actually just post a video revising it. I know I did it in a rush. So partnerships. Let's discuss first what has changed. Okay, so last year and in grade 9 and in grade 10, you guys dealt with a sole proprietor. So this year we are dealing with partnerships. So what has changed? Well, obviously now there isn't just one owner, there are 2 to unlimited partners. So they're not called owners anymore, partners. And because there are these many partners, we're going to have to divide the profit between them, which is one of the downsides, but we'll discuss that later. Okay, now there are a lot more T accounts that we have to do, and I'll introduce them as we go. So let's start with the first one being capital. Okay, now remember there are more than one partner. So because of that, each partner will have to contribute their own capital. So each partner will contribute. Okay, and we only record capital in here. Generally what it says in the partnership agreement is that the amount isn't necessarily allowed to change, but because if it does change, so I'm going to just say here, any changes, you have to update the partnership agreement. Okay, so at any point, the partner, he can put in more, so he can put in additional capital, which will obviously increase his owner's equity. Okay, and sometimes he can actually decrease the capital. But what is so important here is that this is not the same as drawings. Drawings and decreasing capital contribution are not the same, and please remember that. So there it is there. So the owner can increase capital or he can decrease his capital, but when he decreases the capital, it's not the same as drawings. So now, because we have more than one partner, we're gonna have to have 2 separate capital accounts. So I'm just going to draw up these T accounts for you. Okay, I'm only going to work with 2 partners, but sometimes there can be 3, sometimes there's 4. We generally in high school accounting just deal with 2 partners in exercises. So we've got capital and we have to name the partner. So for example, we could have here in Grobler or just Grobler. And then we'd have the capital account for, let's say, loan. Okay. Now remember, capital is an owner's equity account minus plus. So obviously, we can start with an opening balance. If the business has been running for a while, okay, and both partners will have opening balances. Okay, then ways in which a partner's capital could increase. Let's say maybe he gives cash, and that would obviously go in our CRJ. Another way that they can increase is maybe they contribute a vehicle, okay? That would obviously have to go into the GJ, okay? Then with this partner, again, this person can contribute using bank. It's CRJ because obviously we'll be receiving money. The business will be. And then let's say this partner contributed equipment. GJ. Okay. And then, like I said, sometimes the partners are able to withdraw capital. This is for whatever reason. They just want to decrease the investment that they have in the business. It is allowed, but again, it is not the same as drawing. So it's not for personal use. It's just that they're taking money out, which means because they're taking capital out of the business, they're going to obviously earn a smaller net profit. Well, portion of the profit. So here we've got, if they were taking out money, bank CPJ, because our bank will be decreasing. And same with low, bank CPJ. There. Okay, and then let's just make a note again, just so you guys don't forget, because this is how we trick you. Okay, this is not drawings. It's just a capital withdrawal. Okay, perfect. Now, when we discuss this capital, what's super important, so let's do it in this color, in B, okay, the capital amounts, or the capital accounts even, they determine how profit will be split. Okay, so this is where we start talking about a ratio, okay? Now, because we are sharing profit, I just want to switch my lights on. Okay, because the partners have to share profit, it is done according to how much money they have invested in the business. So let's say I invested 1 million rand and Mrs. Lowe invested 5,000 rand. Would it be fair that we share the same amount of profit? No. So however much you invest is what you are entitled to in terms of profit in the profit sharing ratio, but also you have a risk when it comes to loss. You'll obviously, the person who's contributed the most capital will obviously suffer the bigger loss if there is a net loss. Okay, so that is capital. Next. Okay, next, the very most important account I'd say in this section is called the current account. So let's discuss number 2. Okay, so a current account you've never heard of, but it's going to be essential in this section, and we also have a note on this section in the financial statements. Okay, so what's important about this T account, and remember there's 2, 1 for each partner, okay, is that this T account is going to give us an indication of what each partner is entitled to versus what he has already taken. Okay, so it's what he is entitled to versus what he has already taken. Okay, so let's discuss what the partner is entitled to, because if he's contributing capital, he's then entitled to various things. So what he is entitled to is definitely a salary. Okay, now a salary, remember, is a 12-month figure. It's an expense. However, we need to discuss salaries a little bit later. Okay, sometimes a partner is also entitled to a bonus. Okay, a bonus obviously depends on like how much work he's contributed. Is he the best partner in terms of bringing in customers, things like that, but we'll discuss that later. Bonus, he's also entitled to interest on capital. Now, this is obviously the capital that he's invested in the business. As in the partnership agreement, we discuss an interest rate on this capital amount, which is nice because when it comes to financial indicators, we'll be talking about whether the interest that he's earning, is it better than what he could get from, let's say, a fixed deposit, okay? So he'll be getting that. And also the last and most important thing is the portion of the profit, okay? But sometimes it could be the loss, okay? And I just want to put here the remaining profit and put this in big writing. I don't have highlighters, but I'd highlight this pink glitter pen, whatever. This remaining profit I'm going to talk about a lot. Okay. And then when we talk about what the partner has already taken, this we are referring to drawings. Now remember, as an owner of the business, you're entitled to take things from the business for personal use, but we're going to be talking about drawings in a different sense when it comes to partners. Which, when it comes to drawings, sorry, I'm just trying to contemplate whether I should tell you this now, but this is for his own personal use, but this is also the way that we give the partner his salary throughout the year. Technically, the owner is only entitled to this salary at the end of the year. Okay, so this is all year end. Okay, but can we expect the partner to live for 12 months without issuing this salary right at the end? No. So what we do is every single month when he takes out his salary, we call it drawings, and only right at the end of the year will we then transfer that to a salary account. But I'll explain that in further detail. Okay, so what becomes important now, and this is what I always refer to, is the profit sharing diagram. And this diagram is life, people. I always draw this when I do these accounts. Okay, so we're going to draw like a little, I call it a cake. Yeah. Okay, so now let's discuss. I'm just going to take this purple pen. You can use a highlighter. I've left all my stationery at school. Okay, so here's our nice, big, delicious cake, okay? And this cake, what it is called, is our net profit, okay? And we obviously find our net profit in our income statement or in our profit and loss account, okay? Now, the partners in a partnership do not just get to take this net profit and split it in half, okay? First, what we have to do is give them everything that they are entitled to. Because why? None of these accounts, these pink accounts here, okay, they are not in the income statement. Please, please, please remember that. And it's for this exact reason, because from this big net profit, which is just operating income minus operating expenses, we then have to take that net profit and start giving each partner what they are entitled to. So, for example, we have to give a salary to both partners. So let's say salary for Krobs and a salary for Low. Okay, so that's the first thing we have to do. What can you see is starting to happen to our profits? It's obviously becoming smaller, okay? Then we need to give one a bonus. So let's give a bonus to Low. This is for hard work, bringing in extra customers, etc. Then we have to give each partner their interest on capital. Okay, can you see that there's only one account here? Okay, let me turn this so you guys can see. Okay, the interest on capital. And then we are left with this little portion here. Okay, so as you can see, our net profit has decreased. And this here is what I call the remaining profit. This is what is left over. So I call this whole process cutting the cake. Okay, so this is the remaining profit. This, what is left over, this is what we split according to the ratio. Okay, not the entire net profit, just the remaining profit is what we split. Okay, so now each partner has a current account, and I just want to show you this. But over here, these pink accounts, okay, this is what we call the primary distribution, because this is what we give to the partners first, because it's what they're entitled to. Okay, and then once we've given them everything that they're entitled to, that we legally have to give them, we then are left with this blue portion, which is called the secondary or the final distribution. So that's what they get last, what we give them last. Okay, so, and we talk about these two distributions quite often, but it's simple. Give them what they're entitled to and then split whatever left over. That's what's the final thing distributed. Okay, so let's draw up the T accounts. Remember, there's two partners, each entitled to different things. So we need two T accounts for that. Okay, so we have the current accounts for Grobs, and then we've got the current account for Low. Again, these are owner's equity accounts, so we see them as minus plus. Okay, now remember, these T accounts are everything that the partner is entitled to what we have to give them, versus everything that he has taken. Okay, so there's always an opening balance. Okay, can you see this is on the positive side? However, sometimes the partners can have a negative opening balance. Okay, and let's discuss these. Okay, if it's positive, that means he still has money invested in the business. Okay, so that means whatever he was entitled to, he definitely didn't take more than what he was entitled to. Whereas with this person, Low, it's on a negative balance, which means this partner took more than what they were entitled to. So I'll put here, took more. Okay, so let's say they were entitled to 500 Rand, they took 750 Rand. So they're in a negative balance. They actually owe us money because they took too much. So yeah, everyone happy with that? So now let's give each partner what they are entitled to. And what will they do to their owner's equity? It will increase it. So, for example, the salary for Grobs. Okay, and we do that in the GJ. And what else? We need to give the salary to Low. Okay, then did Grobler get a bonus? Nope, but Low is entitled to a bonus. Also with GJ. Okay, then interest on capital. And interest on capital. Okay, And then we have to talk about what they have already taken, and that's drawing. So what will that do to their account? Decrease it. So on the debit side, we will have drawings for groups as well as drawings for low. Do you see? We'll do the drawings accounts in more detail, but do you see how each one has their own drawings accounts? GJ. Okay, now I'm not done because he is also, well, both of them rather, are entitled to this remaining profit. Okay? We have to go into more detail with this remaining profit, but where it actually comes from and how we calculate it is in the appropriation account, which is something you should all know already. Again, this is just revision. So this is the appropriation account, the GJ. Okay. And this is the remaining profits. Okay, but now sometimes, or this one would also get appropriation. Okay, remaining profit. Okay, but sometimes we can definitely get a loss where the business has made a loss. That means that the owners are liable to that because there's unlimited liability for those of you doing business. Okay, so sometimes we can have appropriation on the debit side, appropriation, GJ, and this is a remaining loss, very important, remaining loss, and here, appropriation, GJ, a remaining loss. Okay, so everything they're entitled to versus everything they take, and you then balance that. Okay, so that is the current account. That is probably the most difficult one other than appropriation, but once you start practicing, you'll get used to it. Okay, so let's discuss the other accounts now, the other basic accounts. So we'll start off with drawings. Right, let's just write a note here. Drawings. Okay, so when we discuss drawings, it's important to note that when we issue a salary, excuse all the noise, issue a salary during the year, we call it drawings. Okay, so and why is that? Because a salary okay, so we issue a salary during the year. So whenever he needs to take out money for his expenses during the year, it will be done through drawings. Why? Because like I said, this amount here, this salary amount, what he's entitled to is a 12-month figure. So we don't touch this salary amount until the end of the year. But we can't expect him to live without any salary. So throughout the year, when he takes out money and when it says give him a salary, that is done through drawings. Okay, so each partner will have their own drawings accounts. Okay, so it's groups and drawings for low. Okay, drawings for low. So remember, drawings is plus minus. Okay, and the different ways he can take out drawings is bank, CPJ, or she rather. Okay, also here, bank, CPJ. Okay, at any point, the one of the partners can also take trading stock. Definitely possible. Okay, this is the salary portion. So anytime when it says issued a salary during the year, you know it is drawings. Okay, then another thing that sometimes people forget is asset disposal, if the owner takes any of the assets. Okay, then as you can see, this is all done during the year. So let's just take a note here that all of these are happening during the year. Okay, and then at year end, we then need to close the drawings off account to where? Remember, this is everything that he is taking. So this drawings needs to be taken to the current account so that we can see how much do we as the business actually owe them, or what do they owe us. So over here, look, there was our double entry. Okay, so we need to close off drawings to the current accounts. Okay, and here, current accounts follow. Okay, this is a year-end adjustment. So we can see, okay, how much has he actually taken versus what he was entitled to, because sometimes they take too much. And we know in the partnership agreement, they're entitled to however much money, and they're just taking these large amounts of cash and assets, which isn't allowed. Okay, so that is drawings. Then, let's discuss. So this was actually number 3 was drawings, apologies. Then, number 4 is the salaries. Okay, now, this salary, okay, this is the 12-month figure. I cannot express this enough. Okay, this is what we do at year end. Okay, because we know that this is what he is entitled to. This is what he should have taken. Okay, so each partner will then have their own salary T account, okay? And this salary allowance, okay, it is dependent on the hours worked, their qualifications, as well as their experience, okay? It has nothing to do with their capital at all. Okay, so each one will have their own little accounts. Remember, this is done at year end because during the year, whenever he wanted a salary, he took it out with drawings. Okay, so there'll be a salary for groups and a salary for low. Okay, so now remember, a salary is everything that they were entitled to. Okay, then because of this salary, we have to give it to them in their current accounts because they're entitled to it. So over here, if you look back at your current accounts, there is the salary that they are entitled to. So at the end of the year, you know, okay, remember it is like an expense. It's not actually an expense, okay? So it's plus minus, okay? So we need to give the partner his salary. Why? Because he is entitled to it. So over there, the expense is increasing. So we'll send it to the current account of groups. And then the expense is increasing. Why? Because the owner is entitled to the salary, current account for low. Okay, and you've already done, oh, excuse my spelling, you've already done the contra entry. Salary for Groeps, salary for low. Salary for Groeps, salary for low. Okay, but now, this needs to close off, okay? But I'm going to discuss that a bit later. So I'm just doing the entitled versus taken, okay? So that's done. Hopefully I'm not moving too fast and you're just pausing. If I am, and getting the notes down. Okay, then we need to discuss the fact that we also offer bonuses. Okay, so this is number 5, the account number 5 that I'm discussing with you. Okay, now, a bonus is only granted to one partner for exceptional work done. Okay, and what's important here, and pink glitter pen, okay, it does not change the profit ratio. So just because one person is receiving a bonus, it doesn't change like the amount of capital they put in or anything like that. So remember, only one partner gets a bonus. So we gave the bonus to low. So over here, we've got a bonus account. And who's it for? Low. Please, guys, it's so essential that you do this colon with the specific surname, because that's where you'll lose that mark completely. Okay, again, this is like an expense plus minus. Okay, so where does the bonus have to go? How do we give it to the person that is entitled to it? We have to send it to their current account. Why? Because that account is everything about what a person is entitled to versus what they have taken. And if you see there, just look up here, there is the bonus for low. Okay, then the 6th account I'm going to discuss is interest on capital. Okay, again, you can see I've left bonus open here. This needs to close off. We're going to discuss where it's going to be closed off to. Okay, now, the interest on capital account, why we have it is that it allows us to compensate for partners with larger investments. Okay, we're trying to reward partners who are putting in a lot of money. It's only fair in that regard. So not only do you get your split in the remaining profit, but you also get a bit of interest on your investment that you've made, which I think is a good thing. Okay, there is only one account for it. So we've got just one T account for interest on capital. Okay, again, it is like an expense, plus minus, okay? Now, if we're giving the partners, they are both entitled to this interest on capital. Where do we give partners what they are entitled to? In their current account. So over here, current account for Groeps and current account for low. Okay, remember this is worked out on the actual capital amount and it's a percentage. Okay, Depending on the exercise, it will say that it's worked out at the end of your balance, the beginning of the year. Sometimes there's changes in their capital. So yeah, you really have to watch that. Again, I'm leaving this open because we'll have to send it to another account. And finally, I am at that last account, the very most important account, and it is called the appropriation account. Now, this account is actually very much our little cake that we drew early on, the profit sharing diagram. And this is because it's a calculation account. That's what's important here, okay? And what is it helping us calculate? It's helping us calculate that remaining profit, okay? So that we know exactly what to split amongst the owners. So remember, we give them everything that they are entitled to, and then we need to work out this remaining profit, okay? And that means if we're doing this in this one, we're going to have to do the splitting, the ratio, okay? Because we're not just paying it half and half, okay? Sometimes it's 2-to-1, 3-to-1, 4-to-1, okay? It depends on the partnership agreements at the time. Okay, so now, when we're talking about this cake now, okay? And remember, this big portion of the cake, what was that? It was the net profit. That's what we're trying to appropriate. That's what we're trying to split, okay? So, we are going to have then, where are we going to get our net profit? From the profit and loss account. So over here, we can have the profit and loss account. Oh, I forgot to give my T account a name. Appropriation. Okay. Minus plus is how I see it. Remember, it's a temp account, but I see it as an income because we're dealing with profit here. Okay. So if I'm on the plus side, this obviously is a profit. Okay, but sometimes we have a net loss, which the owners are going to have to share too. So on this side, on the minus side, profit and loss. Remember, this is all done in the GJ. And this would be a loss. Sad. Happy. Okay, so now, how do we appropriate? Here, look. Here's our cake. We need to start splitting the cake. How are we going to do that? Well, we have to give we can't just split this net profit. We have to give everything that they're entitled to. Salary, bonus, interest on capital. So, like I did over here, I left the salaries open. Do you remember? So, where are we going to close the salary account off to? Well, we're going to definitely have to close it off to appropriation because that's one of the slices of cake that we have to cut off. Okay, XX, and then over here, appropriation. And remember, this is all done at your end. Okay, so we're closing it off to appropriation. So we come here and look, here's your big profit, and we're cutting the cake. So what's it going to do to our profit? It's going to decrease it because here, credit, and then we need a debit entry. So we've got salary, and here we're literally cutting the cake, and the cake is getting smaller. We have this huge profit, and now it's decreasing. Why? Because they're entitled to a salary. Okay, both of them are entitled. Salary for low. Okay, so now we've cut off the salaries for both of them. Okay, then what else are they entitled to? What else is coming off that cake is the bonus. And over here we've got the bonus for low. We need to close it off. Where's it going to get closed off to? Appropriation, because that's going to decrease the net profit or decrease the remaining profit that they're going to get. Okay, credit. And then we need to debit. Why does it make sense? Because it's decreasing. We're cutting the cake. There's the bonus coming off. Bonus for low. GJXX. And lastly, the last thing they're entitled to is the interest on capital, where we're going to close it off to appropriation. Okay, and remember, indicate that the account's closed off with the double line. I haven't done that with all the other ones. Okay, and on what side? Well, there's your credit entry. You need a debit entry. Interest on capital, GJXX. Okay, so now we've cut the cake. Look, big net profit minus all the slices of cake. What are we left with? The remaining profit. And remember, this remaining profit needs to be split between Grops and Low. Okay, and they are entitled to it. So where do we have to give it to them? In their current accounts. Okay, so over here we will have current accounts. Obviously, in order to work this out, you'd subtract and you'd see where the balancing figure is. That balancing figure you'd split. But I'll explain that more when I'm doing the activities. I just want to get the basics down now so you know where to put everything. Okay, and then current accounts for Low. Okay, so let's go see where this would end up. So over here, actually, sorry, this was meant to be green, but it's fine. Here's your credit entry, current account. And look, it lands up on the debit side. So this was actually supposed to be my green. I apologize. But hopefully using highlighters. This is the green. And this would be if there was a remaining loss, which would suck, okay? Because we give it to them, and look, it's decreasing their accounts. There's the debit for the credit, okay? Which means if there was a remaining profit, okay, that would go here, and we would put there. They're entitled to it, so it has to go to their current accounts because that's where we see what they're actually worth. GJXX, current accounts for Low. This was for Grobla. XX. This here, people, is a remaining profit. And how do we know that for sure? Because if you go look at the double entry, so look here, debit, appropriation, and then credit, the current accounts on the plus side, which is a good thing. So they'd be happy about a remaining profit. So that is all the new T accounts you need to know for partnerships. In my next video, I will be doing an activity on partnerships. I'm not sure what it is now. It's with, I think it's 5.14 or something like that, where I'll be doing all the calculations, etc. I hope this helps, and I hope I didn't go too quickly. Please let me know if I am, and I'll slow down in the next video.